Next, it's that time of the show where we do a deep dive into the markets. And joining the broadcast this week is Mike Zuzolo, President of Global Commodity Analytics. Mike, it's good to see you. Thanks for making time for us.
Thanks for having me, Bryce.
Absolutely. Well, let's talk about soybeans. A little bit of a premium built back into the market. I imagine a few different factors, but what would you say is the leading factor for that?
I think the leading factor is probably the idea that with 50% of the harvest probably in the bag at this point, and the U.S.-China meeting expected between the two presidents next week, the soybeans have erred on the side of wanting to take on some additional risk premium. I would also say, Bryce, probably part of this goes back to, especially this recent week, goes back to the fresh sanctions on Russian oil seems to have ignited the short covering in the WTI crude. And I think that's spilled over into the soybean oil. Last fourth leg of this stool, maybe, that's helped push these beans up to new monthly highs, get us up to some pretty significant resistance in the front end around 1040, is the idea that maybe we have, because of the spreads, maybe because of the situation with the cash basis in some locations, found a little bit better space issues in some parts of the Corn Belt. Clients in Illinois, for example, are calling me, telling me that spot beans are now steady with the futures at this point. A lot different than what's going on in the Dakotas. Still rough riding out there, but the Illinois areas, Mississippi River areas, starting to free up, it sounds like, a little bit more in terms of premiums coming back in. Be extra interesting given that we go into November delivery at the end of the month.
Interesting insight. Appreciate you sharing that, Mike. Of course, the story with beans here over the last several months has been the fact that China has not bought any vessels of beans, and that has certainly made for challenging prices and conditions, as you mentioned, in the Dakotas, areas that would typically have a lot of exports head out to the PNW. Has there been any developments that make you optimistic that there could be some sort of trade deal or negotiations made between America and China at this point?
Right now, no, Bryce. I can't say that I see a lot going on in the positive direction. In fact, Asian sources would suggest that we don't even know if there's a real meeting set up at this point. There was supposedly a conversation back in the middle of September that was going to allow the APEC meeting at the end of the month here to be kind of the off-road map or off-shoot to getting the two presidents together. Asian coverage of that is suggesting that that's not even set up yet. So I think the big thing that I would be looking at, it's related to your question, is the idea that in this later part of the week's trade, as the beans rally, we're also seeing the gold come back and move back above 4,000 an ounce. And I think that's a really key element to kind of the gauge, the canary in the coal mine, as to the trade fears or less trade fears. And as gold goes higher and the dollar goes lower, the trade fears increase. So I think something's going to have to give. I'm encouraging clients and subscribers to watch not just this November 25, but the back end November 26 beans, because we are getting closer to that $11 handle at this stage of the game.
Well, so far we've talked soybeans. We've got gold in there as well. Mike, let's talk corn. We've been a little firmer in the corn market, I think, as you and I talking here on Thursday morning, higher the last 7 of 8 of these sessions of the futures market. What's been giving the legs to the corn market?
Legs has been demand, and I think also a little bit more rhetoric, anecdotal evidence around both sides of the Corn Belt that the yields, as we get into the second 50% of harvest, not really what they were expected, a little bit weaker, whether it's disease pressure or flash drought pressure. It seems to me, Bryce, that maybe the trade's picking up on that. It seems like the old crop, new crop spread is picking up on that as well, with D's 25 coming up better than the July 26. I would also offer the idea that we've got some very strong demand still, export demand and ethanol demand. Weekly numbers very strong, and the EIA is suggesting at this point that we're probably going to see, for a second year in a row, record ethanol exports. So that 425 level has been resistance. It continues to be resistance. I feel like the corn is justified to go higher based upon supply demand fundamentals, but the wheat market continues to hold it back. Why? Because soft red wheat is now back to a feed grain when you look at the wheat corn spread.
Let's go over to the livestock sector. It's been a frankly weird and wacky week for the cattle markets. We could spend a lot of time on this week's show diving into all that's happened. There's been tweets out from the president, some planning by several of the cabinet members of the Trump administration into revitalizing the cattle industry as we're at record lows in terms of the herd. Right now, yesterday we went limit down based on a tweet and some other factors, I suppose, Mike. But as it stands here Thursday morning, we're not limit down. How do you size up the cattle market?
I would take a step back at this point between now and the holidays, Bryce, even before this recent news broke of buying into and importing Argentine beef and some of the new policy initiatives that came out midweek. I've been talking to clients and subscribers about the similarities to 2014 and how we made a high in October back in 2014, had a substantial correction, a correction big enough even if to keep the uptrend was probably worthy of stepping in and getting some hedges in place and covering yourself and getting some floor prices in place. This news from President Trump about bringing in Argentine beef really reminds me a lot of what we did in the policy when it came to those astronomical egg prices back around Easter of this year. And so I feel like the beef policy, the egg policy are pretty much one and the same at this point. So watching key support resistance levels and watching September lows, for instance, in feeder cattle especially. But I think, a 15-20% correction would take you down around 320 on feeder cattle. That's worthy, I think, of getting some paper hedges in place.
It's a good point you brought up with eggs. Remember that, what could happen here when it comes to beef prices. Mike, appreciate you joining us on this week's broadcast. Again, thanks for the time.
You bet. Thanks, Bryce.
Mike Zuzolo, Global Commodity Analytics, our guest. Next week on the show, we'll be doing a deep dive into the cattle markets, let you know everything that has transpired that might be impacting both the live and feeder cattle markets.